Welcome to the MUFG Global Markets FX Week Ahead podcast with Derek Halpenny, Head of Research Global Markets EMEA and International Securities. It's Friday, 12th of August 2022, and joining Derek to pose some questions on the financial market themes for the week ahead is Matthieu Gloux, Head of MUFG's Global Client Sales for EMEA. The following podcast is intended for professional investors and eligible counterparties only, and not for retail clients. Any content should not be regarded as an offer to conduct investment business or an investment recommendation, but for information purposes only.
Hi, Derek.
Hi, Matt.
So, we've had a big dollar sell-off this week following the weaker than expected US inflation data. Is this a meaningful turn for the dollar after the long run of higher than expected inflation prints?
Yeah, I think for sure, Matt, it's a significant data set. It's if you go out more than one decimal point, it was actually a decline month on month, which is the first headline drop in inflation since May 2020. And according to the kind of Bloomberg metric of surprise, it was the biggest downside surprise since September 2021. So given, as you said, this long run of higher than expected inflation, it's unusual, and therefore in that context it's significant because it gives some balance to the potential expectations going forward. So in that sense, it is important, but I think we need corroboration of a turn before it can be truly significant from a market's perspective. And for corroboration, obviously, you need more evidence than just one report, and therefore, at least another, if not three, downside surprises or evidence of a sustained turn would be required for the Fed to acknowledge it as meaningful. And in that sense, I think it's premature to assume that the dollar is going to turn around and start to weaken. There was good news in it. The culprits for the initial surge in inflation post-COVID, so the likes of used cars, airline fares, lodgings away from home, they all declined. So therefore, there is real evidence that the initial phase of inflation post-COVID is now reversing. So in that sense, it's significant. But services inflation is picking up, and rents within services inflation, in terms of the owner equivalent rent component, that's 30% of the core CPI, and that was up 0.6% month on month. And that's just not consistent with price stability. Then, of course, you had the Cleveland Fed median annual inflation rate released on the same day on Wednesday. It accelerated from 6% to 6.3%. The 16% trimmed mean version accelerated from 6.9% to 7%. And then, of course, now just today, as you saw, Matt, we've seen the University of Michigan inflation expectations for 5 to 10 years accelerating from 2.9 to 3%, and the markets are expecting it to drop. So, there's a lot of counter arguments in terms of whether or not we're about to see a turn in inflation. And then, of course, we had productivity data this week where unit labor costs quarter on quarter annualized grew in double digits for the second consecutive quarter. And of course, unit labor costs are crucial for underlying inflation because 70% of production costs is labor, and those kind of gains, it's very difficult for companies not to pass that on. So the risks are still there, and for that reason, I think the Fed are going to remain hawkish, and we've already heard that this week. Fed President Daly today saying we're nowhere near done yet. And I would expect that rhetoric to certainly continue, and therefore the markets, I think, will start to possibly reconsider 75 basis points in September. Certainly, if we get a strong labour market report at the beginning of September and another inflation print that isn't as good as this week's, and then suddenly 75 basis points is back in play. So definitely premature, and we just don't think the dollar is about to sell off.
Okay, interesting. So if the Fed, as you say, is going to remain hawkish and inflation nevertheless starting to come down, what does that mean for the bond market, equity markets, and FX as well?
Yeah, like up until this week, there's been a clear trend in terms of the 2s, 10s yield curve inverting. And that's turned a little bit this week. So, we got to minus 50 basis points the day before the inflation print. We're trading about minus 38 now. So the inversion has slightly reversed. I wouldn't read too much into that. We did have a relatively disappointing 30-year bond auction last night, and that triggered this bounce in 10-year yields, and we've seen some reversal. But if the Fed continues to remain hawkish, like I just said, I think they will, your point about inflation, maybe, signs of better times ahead, that kind of mix, coupled with the equity market having rebounded, it means the Fed have to be more hawkish, and in that sense, we could see, I think, further inversion of the 2s, 10s. And in the context of the equity market bounce, and the Nasdaq is now up 20% from the low in June. The S&P is up 15% from the low in June. So pretty significant. And we looked back historically at the 2s, 10s inversion and kind of looked to see historically what happened with equity markets and with the US dollar. And we picked out basically there's 9 clear episodes of 2s, 10s inversion. The first one being in 1978, and the last one 2019 before the pandemic. And interestingly, the average period after the first point of yield curve inversion to the equity markets peaking is actually 12 months. And that in itself obviously suggests that there's potentially more. Now that's an average, but generally it's fairly. There was 1 or 2 short periods. 2000 was actually only 6 months, and that was maybe a similar time to now, in terms of the way in which the Fed were raising rates prior to that turn when the 2s, 10s was inverting in 2000. But nonetheless, the point is that we could have still a fairly decent spell of time before we get another lurch lower in terms of equity markets. And then when you kind of look at the FX performance, again, we've looked at the 12-month dollar performance after that first point of yield curve inversion. And, in general, the takeaway is that the greater the inversion of 2s, 10s, generally the better that is for the US dollar. And of course, as I said, we got to minus 50 basis points this week. And that would be, beyond that, would be getting back to levels we haven't seen since the late 1970s, early 1980s. Back then, once the Fed got control of inflation, and the gains for the US dollar were very, very significant. So it's not clear cut, but generally speaking, if we see curve inversion going back and falling below minus 50 basis points, that to us is a signal of further dollar strength. And certainly given the fact that the Fed were so slow and behind the curve in terms of raising rates for the first time, I think they're going to be slow to stop. They're going to make sure they've got inflation under control, and that to me spells curve inversion and I think renewed dollar strength.
Thank you. So conscious that the lag in this phenomenon for it to materialize is uncertain, what does that do to your recent trade views? Any new trade ideas that you published in the FX Weekly?
Well, yeah, like based on what I've just said, we're inclined towards long dollar trade ideas. So we already had a long US dollar, short Canadian dollar position. Now that's worked a little bit against us. There are some counter forces there in terms of CAD tends to perform well in periods of risk on and equity market performance doing well. And clearly we have that at the moment. But of course, crude oil prices have been dropping, and that's a negative for CAD. So they've been kind of offsetting each other, but obviously the equity market support has been the greater one right now. I'm not convinced, although I don't think equity markets are going to reverse sharply from here. We've had a big bounce. I'd be surprised if we had a significant gain from here. So if anything, over the next couple of weeks, maybe the equity markets will stabilize at these levels, but we still have a modestly bearish view for crude oil over the short term. It seems very clear that Russia's ability to continue to supply crude oil into the global markets is a lot greater than what was hoped for. And I think that's having an impact in terms of putting downward pressure on crude oil prices. And there's potentially more of that to come over the short term. And then we've put on a new trade idea, short euro dollar. We just think the bounce in euro dollar is now reversing, and we think that's going to have further to go. The energy story in Europe makes it very, very difficult to become bullish on euro over the short term. And if we're right on the broader US dollar and the Fed being hawkish and the potential for the markets to come back to the idea of 75 basis points, then I think euro dollar can go back down and threaten parity again in a relatively short period of time.
So much for the summer doldrums. Thank you, Derek.
All right. Thanks, Matt.
Cheers.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe, and contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.